Good morning and welcome to our comprehensive market analysis. Today, we are navigating through a complex web of financial narratives, from the bustling streets of Mumbai to the high-stakes boardrooms of Wall Street. Our focus will be squarely on two pivotal economic powerhouses, the Indian market, which has faced recent headwinds, and the intricate global macro landscape, heavily influenced by central bank actions and the buzz of groundbreaking tech IPOs. We'll explore critical policy decisions, significant capital flows, and the underlying currents shaping investor sentiment across continents. This is an era where local news can ripple globally, and understanding these interconnections is paramount for every astute investor. Stay with us as we dissect the data and project what lies ahead. Starting with the Indian market, the recent budget day brought an unexpected jolt, particularly for derivatives traders. Indian shares, including the Nifty and Sensex, sunk as a derivatives tax hike weighed heavily on sentiment. This move, coupled with a perceived lack of significant new measures to attract foreign capital, left many investors cautious. The initial market reaction underscored a broader concern among foreign portfolio investors, or FPIs, about policy stability and a clear pathway for easier capital deployment. This immediate correction highlighted how sensitive the market is to fiscal policy changes and the critical need for a supportive regulatory environment to sustain growth momentum. Following the budget's lukewarm reception, we've observed continued FPI selling pressure in the Indian stock market. This outflow directly impacts the Indian rupee, contributing to its depreciation against major currencies, a classic supply-demand dynamic. Finance Minister Nirmala Sitharaman, while offering capital gains tax relief for G6, quickly emphasized that this alone isn't the end of the story, stressing the urgent need for more foreign capital. Experts at Mint and Reuters have echoed this sentiment, prompting domestic retail investors to question their next moves. Despite the FPI exodus, domestic institutional investors, or DIIs, have largely acted as a crucial counterbalance, absorbing some of the selling pressure and providing a layer of stability. Beyond the macro policy shifts, India's corporate landscape continues to evolve. We are seeing interesting developments, such as Shriram Finance's stock performance attracting attention, indicative of a vibrant financial services sector. Yahoo Finance Singapore highlighted Amazon's accelerated infrastructure push in India, signaling robust foreign direct investment in key sectors. Meanwhile, the broader private equity landscape is also bustling, with EY reporting on the story so far for pay buyouts in India, showcasing increased M&A activity and long-term capital deployment. This blended picture of domestic corporate strength and strategic foreign investment paints a nuanced view of India's economic potential, despite short-term market fluctuations. However, the global hunt for AI winners reveals a fascinating disparity. The Financial Times reports that Indian stocks are losing out to their Asian rivals in attracting investment focused on the artificial intelligence boom. This suggests India needs to redouble efforts to position itself as a global AI hub. Closer to home, market volatility has triggered familiar anxieties among retail investors. India Today offered a crucial piece of advice: why stopping your SIPs in panic is a bad idea. This highlights the importance of long-term disciplined investing, especially during corrective phases, and underscores the resilience needed to navigate the inevitable market cycles. Panic selling often locks in losses, missing out on subsequent recoveries. Amidst the FPI outflows and budget reactions, the Reserve Bank of India's implicit role in maintaining financial stability cannot be overstated. While no direct RBI policy changes were announced in our headlines, their consistent monitoring of inflation and liquidity plays a vital role in cushioning the market. The robust buying by domestic institutional investors, DIIs, has been a significant narrative, preventing a sharper correction. This DII resilience, driven by strong flows into mutual funds and pension schemes, signifies the growing maturity of India's domestic capital base. It effectively acts as a crucial buffer against external shocks, reflecting a growing confidence among local investors in India's long-term growth story, despite immediate pressures. So, what does this multifaceted picture mean for the outlook on Indian equities? The current environment suggests a period of consolidation for the Nifty and Sensex. While immediate triggers like budget policies and FPI flows are creating turbulence, underlying structural growth drivers remain intact. The long-term perspective, as Samco suggests with top 10 finance stocks in India June 2026, points towards sector-specific opportunities. Investors should focus on quality businesses, engage in systematic investment plans, and maintain a diversified portfolio. India's fundamental growth story, driven by domestic consumption and infrastructure development, continues to offer compelling opportunities for those with a long-term vision, even as short-term volatility persists. Shifting our gaze to the global stage, particularly the US, a significant narrative unfolding centers around the Federal Reserve. Headlines suggest Trump is giving Warsh room to reshape the Fed, signaling potential shifts in monetary policy direction should there be a change in administration. Such political influence on an institution traditionally viewed as independent could introduce substantial uncertainty into Wall Street and global financial markets. Any change in the Fed's leadership or philosophical approach to inflation and interest rates would reverberate through equity, bond, and currency markets worldwide, making it a critical watch point for investors globally as we move closer to key political events. In the commodities space, oil remains a dominant factor. Oil executives send a blunt message to Americans on gas prices, indicating that consumers should brace for continued high energy costs, directly fueling inflation concerns. Geopolitical factors, such as the US stance on the Iran deal, further complicate the supply-demand dynamics. Vance says a lot of Iran deal details to figure out, implying that any changes could significantly impact global oil supply, leading to price volatility. Higher oil prices translate directly into higher operating costs for businesses and reduced purchasing power for consumers, creating a challenging environment for central banks trying to tame inflation. The tech world continues to deliver market-moving headlines, with the much-anticipated SpaceX IPO taking center stage. The news that Ron Barron bought $1 billion of SpaceX shares in IPO, lifting stake to $25 billion, underscores the massive institutional confidence in the company. However, the IPO dynamic leaves retail investors with too few shares and a tough hold-or-sell decision, highlighting the exclusive nature of these high-profile offerings. Beyond IPOs, M&A activity is also hot, with Fox to buy streaming device maker Roku for $22 billion, signaling consolidation and strategic moves in the streaming wars. These developments reaffirm tech's role as a primary driver of Wall Street activity and wealth creation. The broader US market sees continued momentum in specific tech and pharma sectors. Wolf Research raises PT on Micron Technology, MU stock, reflecting strong demand for semiconductors, a crucial component across industries. In the automotive and robotics space, Rivian CEO taking different approach than Elon Musk for humanoid robotics company, indicates diverse strategies emerging in cutting-edge tech. Meanwhile, a major healthcare trend is drug makers' race to find a place in the next wave of obesity drugs, pointing to significant R&D and market potential in the pharmaceutical sector. These sector-specific headlines demonstrate that despite broader economic concerns, innovation continues to drive significant investment and growth opportunities in targeted areas. Beyond institutional trading, inflation continues to put pressure on personal finances. A financial experts advise that $20,000 is a good place to start for emergency funds and that a 3-month buffer may no longer cut it. Reflects the persistent impact of inflation on the cost of living. This highlights a crucial shift in personal finance planning, where previous benchmarks for emergency savings are proving insufficient in a high inflation environment. Consumers are facing tough choices as their purchasing power erodes, prompting a greater need for financial prudence and strategic budgeting to navigate these economic pressures, underscoring the real-world implications of macroeconomic trends on everyday households. In summary, both the Indian and global markets are navigating a period of significant transition and re-evaluation. India is working through budget adjustments and FPI outflows, while simultaneously showcasing robust corporate activity and domestic investor resilience. Globally, we are watching the shifting sands of Fed policy, the persistent challenges of energy prices, and the transformative power of tech IPOs and M&A. The interconnectedness of these markets means that developments in one region invariably influence others. As executive producers, our advice remains clear: stay informed, focus on fundamentals, and maintain a diversified, long-term perspective. These are not times for panic, but for calculated understanding and strategic positioning. Thank you for joining us.